Emerging economies today account for 85% of the world's population and approximately 50% of economic activity, but less than 10% of the average investment portfolio. Investing here favors those who can take a long-term view and back their conviction against a constantly changing market backdrop. This requires the willingness to think independently, to stand out from the crowd, and to be an active and engaged owner of quality companies. Back in 2002, SKAGEN Kon-Tiki was one of the first Nordic-based funds to identify the vast investment opportunities in emerging markets. While the journey so far has been anything but a straight line, our investment philosophy and strategy have remained the same. Our approach is value-based and long-term, which has served us well for more than 20 years. Prior to any investment, we ask ourselves the following: what are the qualities that have been overlooked by the market? What dynamics will change the market's perception to warrant a repricing? What is the true potential return on a 3 to 5 year time horizon? And how confident are we that this potential can be met relative to the risk of being wrong? Idea generation is the flywheel of SKAGEN Kon-Tiki, and the portfolio we have created is a carefully selected one, which provides our clients with diversified exposure to some of the most dynamic regions and industries the world has to offer. Only the very best investment ideas find their way into the portfolio. It is important to point out, though, that we do not invest in countries or specific markets that many of our competitors do. We only invest where we see upside potential. This means you get a portfolio of companies uniquely positioned for considerable revaluation. So what should you think about before investing in SKAGEN Kon-Tiki? We are long-term and very active investors. We want to really know our companies and therefore travel a lot, visiting our holdings in countries such as Mongolia, Korea, the Congo, India, and Brazil, to mention a few. We believe this is important, especially in building conviction in more volatile markets. Share prices in emerging markets move around much more than underlying values, which makes timing the market that much harder, which is why we try and avoid it altogether. Finally, building a diversified portfolio is crucial in managing risk. It does not mean avoiding risk altogether, but it means only taking the risk when we are adequately compensated for it.